today's topic of conversation in the fast-paced, sexy world of property and casualty insurance is going to be understanding risk management basics for the business owner. This is episode 1 of the Financial Poise series, Insurance for the Business Owner 101. I'm going to take care of a little housekeeping here first. Let's get to put that up there. So to learn more about Financial Poise, specifically, you can review slide 37. If you want to jump down to that. Look at that. So our panelists with us today, we have Chris Cahill of Dykema Gossett PLLC. We have John Gottschall of Coach Financial and Lee Burke of Burke, Bogart, and Brunel. My name is Gary Kirschenbaum. I'm with the Alera Group, and I'll be your moderator. So a little housekeeping before we get into the webinar itself. So Financial Poise, nor myself or anybody here intend to be any kind of an infomercial. If you want to learn more about us, you can, there's bios on slides 32 to 35. And about the slides specifically, I will try to call your attention to slides when I think they're relevant, and I will try to keep the slides moving along through the conversation. But if you're listening, not necessarily watching, don't worry. The slides are not that critical. So Financial Poise is supported in part by some sponsors, or a sponsor in this case, National Law Review, your premier legal news website. And then the last thing before we begin, and this is an important one, and get the proper slide, our disclaimer. You are not our clients and we are not your lawyers. What we're here to do today is for your general education and not to act upon without appropriate advice. Okay, so episode number 1, understanding risk management basics for the business owner. Without further ado, let's get into it. Every business owner has at least one contract, right? Excuse me. And despite paying for them and being bound by them, often they don't understand them. My expert panels here hope to dispel some of the mystery and shed some of the basics on risk management and how it relates to business owners. This will be a conversation in plain English, and we'll use some different scenarios to illustrate the material. So, all right. With that, let's lay a basic foundation for the first part of what we're going to be discussing today. And Lee, let's start with you if we can. And just let's talk about the, different aspects of risk management, different steps of risk management, please.
Okay, thank you, Gary. First of all, let me start off by saying that managing risk is different than buying insurance. Insurance is one method to manage risk, but risk management is a much more comprehensive, overarching process. On your slides, you see the 5 textbook ways of managing risk. I'm going to divert a little bit from the textbook items on the slide and address more practical, kind of down-to-earth ways of dealing with risk that may be helpful to the typical business person. And keep in mind that risk comes in a whole different variety of shapes, colors, forms. You've got damage to property, you've got liability risk, you got regulatory risks. There's all sorts of risks that we all face as individuals and businesses every day. So the first thing I would say about managing risk is simply, when you can, avoid it. It's simple. Just simply avoid doing certain things, or doing certain things in a way that's hazardous or creates risk issues. The first step in any risk management process is simply common sense and avoiding risks. Secondly, try to mitigate risk. Now we mitigate risk through simple things like putting on a seatbelt when we get in a car. We mitigate risk by not driving under the influence. Um, we mitigate risk by being prudent in running our business and in running our lives. We also do it in things like safety and loss control programs in business, protective equipment. There are all sorts of different ways of mitigating risk, including once something bad happens, trying to minimize the damage, minimize the loss, minimize the negative effects. That's risk mitigation. Segregating risk is a different way. If you're shipping $1 million worth of products from China, and you have a choice of putting $1 million in one ship, or $500,000 in two different ships, uh, if everything else is equal, put the $500,000 in two different ships. One ship goes down, you've only lost half the shipment. There are many ways we can segregate risk to again minimize and divide up that risk exposure. Um, we can transfer risk. There are many different ways of transferring risk. The most common way is by insurance. You pay a premium, you transfer the financial risk to the insurance company. But we're talking to many attorneys today. Attorneys are classic risk managers. They're constantly transferring risk through legal procedures, through hold harmless agreements, indemnity agreements, contract terms, contract provisions, um, being named as additional insurers, and other things that we'll talk about today. Those are all ways of transferring risk from one party to another. Non-insurance, non-insurance ways of transferring risk. And the last ways is that simply there are certain risks in life that we're going to retain. Simply means we keep them to ourselves. You can't avoid all risk. You can't mitigate all risk. You can't transfer all risk. There's certain things that in life we just have to deal with. Plan for them, plan financially for them, and retain them. So, Gary,
Got
that's
it.
a kind of a basic overview of ways of dealing with risk.
Got it. Thanks, Lee. John, Chris, anything to add to that uh, thorough?
I
Uh,
think I think I would add that, and I'm just thinking about my experience working in pizza restaurants as a kid. Um, that some of it's not all that financial, or at least doesn't involve interacting with insurance companies. It's managing how things are done, making sure that you identify that in a pizza restaurant, for example, the worst risk is poisoning somebody. So how do you address that? You train even the meanest and least so-called least important of employees. Well, they all have to know how to handle food and how to not mishandle food, and that's worth more than upping your insurance premiums, because you can avoid it altogether.
right.
And so some of it is just simply good management, and attending to your responsibilities, because obviously poisoning somebody can kill the business entirely.
Well said. Got it.
That was well said by Lee. And, I think insurance is really because of Murphy's Law, right? What can go wrong will go wrong. And it always happens at inopportune times. And the thing is, if you don't have a plan in place, what is it going to cost you? And how bad can it cost you? And so that's why we have tools like insurance, and why you sit down and prepare for the worst case so you can enjoy the best case.
Got it. Well said. And John, with that, let's talk a little bit about loss exposure, maybe some examples of like what first party is versus third party.
Yeah, as you just said, Murphy's Law. And basically, first party losses are things that can happen to you. And third party losses, when you think about it, is something that damages others. So as an example, few years ago in Illinois, there was a business that are friends of mine that were caught in a microburst. They had a three-story building. The roof got ripped off. So right there, that's a direct loss to their business. Their property was damaged. Because of that, indirectly, they had business income loss. They had a consequential loss because now they had to move their whole operation to a new facility, and that took 4 or 5 months down the road. And so because of that damage to the building, now they probably are going to lose revenue because they have nowhere to work and no backup plans in that instant. And then the contingent loss, which may come of it, is, maybe they shipped out product that wasn't inspected properly, because of how the employees work. So something in a contingent role is a loss that may happen in the future. There could have been people injured that didn't know that they were injured from that horrible event and are suing down the road. So when you look at direct losses, it's really just about the damage to you and your property, and then indirect losses are something that happens to somebody else.
Okay. And talking about the losses, so the losses, before they become a loss, would be an exposure.
Mhm.
And one of the important elements of managing risk is understanding what that potential loss or that exposure is. Can you talk a little bit about how you might measure your exposure, how a business owner can go about doing this?
Oh, sure. So, if you look at your personal property, pretty easily, if you own a building or working, have your own property, the value of your building is what you want to insure it for, right? Number two, if you have equipment, what is the value of that equipment? And so you can basically just come up with a number, the purchase price of that equipment or the purchase price of new equipment. What does that cost to replace? Now, there are intangible things that we just don't know in terms of measuring any type of risk, where if you're looking at it from a employee base, right? If you have an employee dispute or a contract dispute, you know, um, what's a number that you're going to put to one of those transactions? So if an employee makes $50,000 and you have a dispute with that employee, you know, uh, if they sue you, what's that number going to be? So sometimes you have to come up with a reasonable amount that you think may be the exposure or the loss from an event that happens. And of course, there's many different ways that you are exposed in a business. So, from a liability standpoint, it could be giving the wrong advice. It could be something like somebody got injured at your place of business. And if they get injured, what would that cost? Business income loss is really if you can't go back to work. How much are you paying for rent? How much are you paying for electricity? All of that. What would you lose if you couldn't go to your business every day? Human resources losses, on top of what they're making, in today's world, you just can't make a bad joke at the water cooler. As we've seen in the news, that could be millions of dollars when people feel they're wrong. Theft, pretty simply, as an exposure, what's in the cash register? In my neighborhood, there was 5 or 6 restaurants that were broken into and thousands of dollars taken out of the register. So, that's something that can be replaced through insurance. But people don't think about certain things like employee benefits. What happens if you make a promise uh, to provide life insurance and then you never set up the benefit and it was in their employee contract? Now you're liable for those things. And so those are things that people just don't think about, that you may not have an accurate number, but you can come up with something reasonable in case that event happens.
Yeah. One of my favorites in that category of employee benefits is, and this happened at a company that I was at a while ago, but the HR person told a new employee that the benefits kicked in 30 days, and the employee went and had something done that cost, $12,000 or whatever. It was a procedure of some sort when they thought their benefits had kicked in, and they didn't actually kick in for 60 days, and the company became Blue Cross Blue Shield. They had coverage for it because there's actually a line of coverage in
Right.
the program if it's in place properly.
Right.
But a very low risk, but one that should be measured when putting a program together for a company. So
Yeah. Another good one these days you have to pay attention to is some of these health insurance companies will not cover specialty medications. And you can't ask employees if they take medications when you hire them. And so if they think that they're going to be covered and some of these medications are 10,000 a month, now you could be liable for paying that out.
yeah.
So there's a lot in the employee benefit area that nobody thinks about.
Chris, Lee, anything to add to measuring your exposures?
No, I think I covered it very well. On the asset side and the tangible asset side, certainly there are people and companies that you can go to get appraisals, and get valuations on buildings, on inventory, on finished product, et cetera. And certainly, your financial people within the company can do it. And then the other issue is when you're talking about tangible property, there's always a question of, do you want to measure property at its current replacement cost, what it would cost you to replace it today in the marketplace, or at its book value or depreciated value? There are different ways of obviously valuing property from an accounting standpoint. And when you're figuring your risk exposures, you have to think about the same thing, that there are different valuations that can be put on the same item.
Sure.
Well,
Sure.
yeah, to your point, Lee, very well said. It's especially if you own a building, right? You may devalue that property for tax purposes, but value it a higher amount for someone to come in and purchase that building, so that you have two different numbers. What's the right one is a really good question.
Yeah.
Well, one other item on that, particularly, here in Florida where land costs are so high, or, in Chicago where you guys are located, that, where there are a lot of older buildings, sometimes the value in the property is basically just in the dirt. It may not be in the building. The building may effectively be obsolete. So you look at what might be a $15 million piece of property, and you think you need to insure the building. You don't necessarily need to insure it. You got to stop and think about that.
Good questions to be asking. So the next topic, which is really more of a reiteration of what Lee opened with, but Chris, I think it's important that we kind of cover these again in bullet points, because they are the basics of what we're talking about and what business owners should understand about not just insurance, but about how they manage risk around their business.
Well, risk sharing, risk transferring, I mean, that's essentially insurance itself. You transfer the risk of economic loss to the insurance company. But it's easy to say that. It's also a question of executing your responsibilities as an insured to make sure that you efficiently and quickly, better to be quick than slow, report on the loss in a manner by which it makes it easy for the insurance company to cover that loss. So signing an agreement and thinking it covers you is one thing, but understanding all the procedures and all the evidence you need to show, and making sure that your filing processes, your information gathering processes are constantly appointed toward that, and they're useful. Of course, you try to make them useful for every purpose, but what's being insured, you must be on top of the value, as I think Lee was saying. Okay, the value has gone to almost zero. Maybe you should change your insurance company. There's no point in transferring the risk when what you're protecting isn't worth anything. Are we going on to risk sharing as well here?
Yeah, we can talk a little bit about risk sharing, because I think from a business owner's perspective, that's something that is often lost in the big picture when business is being conducted.
Yeah, there might be opportunities for group insurance, you and like businesses combining. This has a great history in America. Excluded groups in America who were excluded from insurance pools pooled within their groups. And that introduced a lot of insurance salesmen into the middle class. But it also had the function of not just transferring risk, but sharing it among like parties, and therefore making insurance available where it might not be available to a single party within that group. And I mean, insurance is basically premium pooling anyway, but you can do it on a more smaller consolidated basis through group insurance.
Numbers.
Go ahead. I'm sorry.
Yeah, no, it's Lee, John, anything you want to add to that part of the conversation?
Well, it's interesting, with insurance, you're always, when you're buying a policy, to Chris's point, you're doing it to protect yourself, but you are part of a community of other organizations that are combining your funds to, help pay for the loss when something happens. And transferring, the financial responsibility to an insurance company when something goes wrong, it's the lowest cost form to get your business back up and running again, in most cases.
Well said. So I think we've done a good job of covering sort of the 30,000-foot look of risk management and a lot of the different elements of it that a business owner should be aware of. But, with all that being said, let's jump into a hypothetical and we can get some more granular details about how to.
Gary, may I interrupt you? There was another point I wanted to make with regard to
Sure.
risk transfer. You think your insurer is covering you. Well, consider what happened in COVID. A lot of people were shocked that force majeure did not cover those closures. I mean, shocked, not just to the core, they're shocked right out of business.
Right.
A law firm I was in was essentially shocked right out of business. Having signed a giant lease and not being able to perform well, turned to the insurance company, force majeure didn't cover that. So what that means is don't be bewitched by the language of the insurance contract for something that is a bet the firm kind of thing, like a force majeure event. Maybe you should consult with an attorney who understands especially what happened during COVID and what kind of language you need to insist on. Of course, the insurance company might reprice the policy, but if that's something you're concerned about, then, or other similar risks, it's
Right.
something to be considered. I just wanted to add that, Gary.
Yeah, well said. Right, so jumping into a hypothetical, so we can get into some granular details here about risk management, some illustrations. So Mopsy and Flopsy have formed a corporation called Flobbier Systems technology company. And so for now, it's really just the two of them as a startup. And as prudent businessmen, they really want to create a proper risk management plan for their new operation here. So, one of the first steps is selecting a broker to get their insurance. Lee, can you address one way they might go about doing this?
I can address a number of ways. The first thing I would say is that they need to decide whether they are really looking to put together a risk management program or just simply buy insurance. And I say that because insurance agents are very, very good at selling insurance, and most insurance agents are capable of doing that job and doing it just fine. But not very many insurance agents are risk managers. Not many insurance agents know much at all about risk management, believe it or not. It would, if you need brain surgery, you're going to go to a neurosurgeon. You're not going to go to your general practitioner. Think of the insurance agent as a general practitioner. I don't want to diss brain surgeons and say that a risk manager is a brain surgeon, but in their field of managing risk, they're a lot more than just an insurance agent. So the first thing is, what are your expectations? Are you simply looking for somebody who's going to sell you insurance? Are you looking for a professional agent and broker that is going to be able to advise you and consult with you and help in a number of insurance and ancillary areas? Or are you looking at somebody that really has risk management experience, risk management knowledge, risk management designations that can help you put together a risk management program? So identify those expectations. Not very many people want to be sold insurance. Most people at least want help and assistance. Some people really want risk management advice. And then go about, once you identify your expectations, go about finding people that are credentialed and fit those, have those skills and qualifications. Ask people in your industry, get references, go online, look for certain, designations, whether it be CPCU or CRM, for, professional risk managers and experienced insurance people. Interview people, go to their office. Wow, you may spend $10,000, you may spend $110,000 for insurance. Go visit somebody's office, meet the staff, because I will tell you that the agent or broker you're dealing with is not going to be the person that's going to be servicing your business on a day-to-day basis. So meet that assistant, meet that account executive that's going to be taking care of you. find out if they're really in office, or if you're going to be dealing with a call center that may be located across the country or across the globe. That may be important to you. Again, ask for their expertise and listen to the questions they ask you. If you go in and you start talking to somebody and they start asking you things like, well, what do you do in your business? What's your address? What type of building you're in? What are the values of your contents? They're asking you questions that they need to fill out an insurance application to sell you insurance. But if they ask you questions like, well, tell me about your business. I'm interested in what you do, but I'm more interested in how you do it. Tell me how your business operates. Tell me what makes it tick. Tell me what the concerns are that you have. They're a risk manager looking to get into risk issues with you. So just let them ask you questions and listen to the questions. Find out if they really have an interest in learning about your business and helping you protect it, or if they're just trying to sell you insurance. It's time consuming, but it's well worth the time you invest.
Got it. John, Chris, anything on selecting a broker and some of the nuances in the marketplace?
Well, I think when you're looking at an insurance professional, first of all, many people look at business insurance, or even when they're getting started up, as a commodity, but it really isn't. You are protecting one of your greatest assets that is a revenue generator, and also your asset is built to help others, right? So it's not a commodity. And so if, a retail shop is, you see a lot of them on the street, and they're looking to just place policies as fast as possible. To Lee's point, when you're working with an insurance professional, they are understanding your business and how it's going to grow, and what are the potential problems that are going to come up on a regular basis that are similar to other businesses. Like a tech business is going to be similar to a lot of service businesses. However, you've got to pay attention to that area of cyber coverage, more importantly than maybe protecting your machines that are manufacturing. So, you have to, the person has to have experience in understanding how to make your business grow.
Oh, and there are of course, other businesses like mine,
Yeah.
or even yours, for which cyber protection would be key.
Mission critical?
Yeah, anytime you have a fiduciary duty, and it includes, information that you have in confidence, a cyber event can destroy you.
Yep.
Or hurt you very badly. And that's just, that's not on the minds of people who are over a certain age. Probably everybody on this call, but outside, our colleagues, the people we grew up with, I should say. It won't be top of mind for them when they're running their particular business.
Yeah. So now they've selected a broker. It's Mopsy and Flopsy here. They've got someone they want to work with. John, you want to talk a little bit about, they're going to rely on the broker, right, to tell them what they need. But I think a business owner should have an idea of what it is they should be looking at to select different coverages, limits and deductibles, any special coverages that they should be looking at. Can you give them a basis, if you will, for what they should know, what a business owner should know about this?
Sure. So most business owners are so focused on what they do best, right? That this is a secondary thing, but the secondary thing, problems do happen all the time. So it's important to understand, when problems come up, how will you be indemnified or made whole again if issues come up? So as a broker, our responsibility is, one, to understand your business, where it is today and where it's going. Number two, do you have employees or don't have employees? Are you giving advice to people, or are you not giving advice to people? Who are you working with? Are you working directly with the general public, or are you working only with other businesses? As a tech firm, how are you doing the programming? What information are you storing in your computers and in the cloud? And is that protected? So our responsibility is to help educate the business owner on potential areas of loss and in where the highest risk areas are, and then to make sure that there's enough coverage when something happens, for those expenses to be paid. And so the broker needs to have an idea of what is your business and where it's heading and what are your pitfalls. Now, a lot of businesses are similar. So tech businesses, service businesses will all have pretty much the same, which would be different than if it was a gymnastic center where now, you would need to work with somebody that's really a specialist in that area because they would understand, the right processes, protocols, how to limit, or reduce any of the claims from different types of teachings and things like that. So depending on your business, the person you're working with, it's very important that they ask the right questions and have the knowledge and the basis to educate you so you can make a really good decision.
Sure. Well, so one of the questions that comes up a lot is how much insurance do I need? And by nature, we're going to talk stereotypically here, but insurance agents want to sell as much coverage as they can because there's more premium involved. Business owners, generally speaking, want to buy as little as they can so they're not spending too much on insurance. So how much do we buy? Does the insurance agent determine you need $2 million or $5 million of liability coverage, or what should a business owner be looking at to determine that amount?
So there's two parts to that. First of all, you may have requirements that are necessary for you to have before, let's say, renting space in an office building. The office building will give you minimum requirements that you have to have, right? Or if you are securing a contract with a government or a school system, you're going to have minimum requirements that they want you to have if you're going to do business. So a lot of business owners will just set up the minimum requirements they need to have to either move into a business or to conduct business with clients, right?
Yep.
However, sometimes, you will give the business owner options. If there's a difference in coverage of $20, maybe it's better just to take the higher amount versus the lower amount because you have more protection. Or number two, maybe you've identified certain areas of your business. For example, if you're a construction business versus an accounting business or a tech business, you're going to want to have better or higher limits because there's a higher chance of somebody getting hurt. So the insurance broker should bring those things to your attention.
Okay. I know I usually say that insurance's limits are usually decided one way or the other. Either you're, as a business owner, you're told how much you're going to have by a supplier or a customer, or budget. Because if it was free, you'd take it all. So, I just think it's important for business owners they may have to adjust their budget, but they should at least have some kind of a budget set up so that they have some basic understanding of what they can afford and then figure out from there whether they need to increase or decrease.
And one way, like especially on the liability on this way, I think it's, taking a peek at what are some of the lawsuits out there, when somebody else is injured is a good way to do it these days, because a lot of that information is public.
Yep. So flashing forward a little bit, and John, you kind of addressed this. Businesses, especially when they start out, often have no employees, but now at some point they start acquiring employees or adding employees. So let's flash forward to floppier here, and assume that now they've got 20 employees. And they've got arrangements with a few other companies that are manufacturing their product for them. Chris, should their risk management be changing? Should they have been adapting along the way? What do they need to change or revise, particularly as it relates to the employees and these outside relationships?
Oh, yes, it has to change. Now you have these new parties involved. And their employees, they are not powerless to affect the outcome of the business, or at least I should say, the results that they're able to accomplish or not accomplish bear upon the business. You might need them to protect themselves and protect you thereby by getting business interruption insurance so that their operations don't stall if there's an event or will be quickly redone. as well as business liability insurance so that they don't die. I mean, I'm assuming that these 20, oh, I'm sorry, you might need, hang on a minute. Well, look, there are two different relationships here. There's the employer-employee, and there's a relationship between the two founders. Something we haven't talked about is how the two founders should interact with one another. Maybe there should be life insurance on the one, life insurance on the other. And they have to spin out a bunch of unpleasant scenarios since they're human beings liable to human death. So is the person who is inheriting it going to be copacetic for the business itself?
Sure.
So if you have these 20 employees, are they? No, I'm sorry, it's not employees, it's other companies. That's what I thought. Okay, sorry about my confusion there. So when you have this other companies, you have an interest in their persistence. They're continuing in business themselves. That's where I was going with business interruption insurance for them, requiring it perhaps, requiring business liability insurance so they don't get done in by some mistake they made and therefore do you in. You should understand their cash management. You should require them to prove that they have insurance, to provide financial information on a periodic basis, so you know that they're not going to fail, and also require them to notify you if they're combining with another business themselves or selling to another business themselves. Again, on the theme of it's not necessarily insurance contracts we're talking about. It's operational community between these entities.
Yeah.
Yeah.
Going back to the overarching concept of just,
Right.
Holistic risk management. Yep. So, and there's probably some more we can unpack around that, but I want to get, this is one of my favorite ones, and it's it has to do with how businesses evolve, right? We started with a startup with 2 people, they've added employees, they've got outside relationships, joint venture type deals, getting product made. But now in order to continue growing, they've got to take in outside money. And I know I've seen this in many times over the years. Lee, what's different now? What changes here when Mopsy and Flopsy get some outside investors to invest in their business?
This is a great question. Well, the first thing that changes is that when you take in outside money, if you screw up, you're just not shooting yourself in the foot. You're shooting other people in the foot, not only in the foot, but in their pocketbook. And that presents lots of new issues and problems and risks. Because you've got obligations and responsibilities to those investors. Now the question is interesting because it says investors. It's not defining investors. Is this a public company and we've got stockholders in a public environment? Are they partners or joint venture partners? Minority partners? Are they simply lenders? Is somebody making a loan to the business? Perhaps it's collateralized, perhaps it's not. So the type of investor is not defined. So we'll talk generally. The first thing I would say is that if you're bringing investors in, you absolutely positively want to be sitting and talking with a good corporate attorney and making sure that you're asking questions and addressing the positives and negatives of bringing those investors in. And as somebody once told me, never get involved in a deal if you don't know how you're going to get out of it. So you want to have something like a stockholders agreement, which is going to address how you're going to get out of the deal, how you're going to unwind the situation if it needs to be unwound. Somebody is sick, somebody gets disabled, somebody dies. How do you repay the investors or buy their stock back or pay off their loans? So these are all agreements that need to be reached and should be codified in writing. From a risk standpoint, when you bring investors, you've got a fiduciary liability. Again, now it's not just Mopsy and Flopsy who can lose their money and go down the tube, but you can take investors with you. So you have an added fiduciary obligation and responsibility to act in a prudent manner to protect those investors. You may very well need or want to be getting officers and directors liability. because now you've got third parties involved. You may need fidelity bonds for employee dishonesty that you haven't needed in the past because Mopsy and Flopsy control all the purse strings and kept all the cash to themselves. You certainly want to be setting certain types of business standards, risk management guidelines, self-insurance thresholds. How much risk are you going to take? How much risk are you going to assume? How large a deductible, or how little insurance are you going to buy? These are things that should be codified in this and talked about among the investors, because it's not just a sole practitioner or a sole owner or two partners that are making decisions on their own. These decisions affect other people. And we already talked about the buy-sell agreement. That buy-sell agreement is very essential. So it's a very, very different ball game when you go outside the family, for lack of a better term, and bring others in. And the first place to start is with a good attorney, and then loop in your risk management, insurance broker, agent, partner for advice and counsel, and your CPA. They should also be involved.
John, Chris?
Well, you know what? To your point, people don't sue poor companies, right? So the more you have to lose. And the more people that you have as you're growing your business, there's the more chances for mistakes to happen and more trauma and more opportunities for things to go the wrong way. And so, the proper insurance, is there to, if you're meeting the qualifications of the policy, of course, that if a problem arises because of growth or because of damage, that the insurance is there to pay for those costs. So it needs to be assessed and reevaluated every year, because growth, sometimes you grow out faster than the insurance coverage can provide.
Okay.
I would add that we have two partners, I think, still owning this place.
Yeah.
The relationship between the two has to be carefully maintained. And obviously, if there's a terrible event and it was one partner's doing, at least in the mind of the other partner, now you're suing each other. And this is why the communication among partners must be very clear, and if they have respective responsibilities, they must be laid out and known by both. You need to keep working with each other. Another problem with partner succession, if a spouse takes over for your initial partner, that changes everything, and you got to be really careful to make sure that decision-making process doesn't cause more problems than it solves.
Sure.
Or they make a decision that's not good for the business and you're liable for it. So.
Yep.
Right. That's a pretty bad situation to be in.
Yeah. So let's move into something a little bit more tactical as far as policies are concerned. John, to be able to give business owners a better idea of how insurance policies are structured, because they're supposed to review them every year, right? This is what we tell our clients: read your policies. We're there to read them, but you need to read them.
Correct.
Can you give a description of the different sections of the policy, what they are, and what business owners might want to pay attention to?
Sure, absolutely. So, first of all, we don't want to hear this, but an insurance policy is a contract. There's an offer, an acceptance, and consideration, and then the policy outlines if a problem happens, what are we going to pay, correct? So the declarations are where you're going to find the who's insured, the dates of insurance, the type, is it a claims made versus claims occurrence policy, and it's going to outline what the limits of those policies are. In the insuring agreement, it's going to give you your definitions. It's going to lay out what is covered under certain provisions, and it's going to also give you details of those conditions of when you have coverage. So it's like any other contract, it's going to lay out those things. However, the most important part, I think, of any insurance contract, whether it's general liability, workers' comp, it could be your health insurance policy, it could be your auto, personal, is the exclusions. What everybody needs to know is, when will an insurance company not pay a claim? For example, you could be covered for fire. However, in the exclusions will say, not if you light it yourself. So you always want to look at the policy, peruse through, make sure that the coverages are correct in your declarations. And then I always jump to the exclusions first to know what wouldn't be covered if Murphy shows up and we have to file a claim.
Okay, got it. Lee, Chris, anything to add on contract construction here?
I would just add one quick thing that, and the point was perfect on exclusions, because exclusions are critical. Keep in mind that there are basically three reasons why an exclusion is in an insurance policy, and virtually every exclusion falls into one of these three buckets. An exclusion may be there because something is uninsurable. You can't buy insurance against nuclear war. An exclusion might be there because something is against public policy. You can't buy insurance for arson, not if you're the arsonist, because that would be against public policy. And it's the third thing, which is really the most common, is that an exclusion is in a policy very often because that type of risk or that type of event is a subject of a different type of insurance. This policy doesn't cover it because you buy it over here. Cyber liability is a perfect example. We call it cyber liability. Liability insurance doesn't cover a cyber claim. Property insurance doesn't cover a cyber claim. You have to buy a cyber liability policy. So, the fact that a policy has got an exclusion, it really helps to understand why that exclusion is there. And lots of times the answer is because you can buy the same coverage in another type of insurance.
Yeah, I mean, after all, if the insurance companies gave all of the coverages in one policy, they won't be able to make as much money. They have to be able to sell more policies, right?
True.
So, actually, Lee, I'll come back to you. I think it's important for business owners to understand a little bit of the insurance world and how we operate, just so that they know when they're selecting a broker, when they're looking at policies, different coverages, and what it is they're looking at, what their broker's talking about. Can you just give a kind of a quick overview of what the difference between an agency system versus an independent system is?
Sure, and I'm gonna throw a third one in as well, because there's been a change in the industry that I think is that's happening, that's important. Um, your direct agencies, or what we may call a direct writer, is typically an agent or an agency that represents one company. Now they may have access to some other carriers, but primarily they're representing a single company. State Farm is a good example. Allstate's another example. I mean, two of the largest companies in the country sell their products primarily through a direct agency system. Their agencies are de facto company employees. Their agents, rather, are de facto company employees. They're not truly employees, right, but effectively they're working with or for that company. Your independent agencies are autonomous businesses that represent a wide variety of companies. They've got a much wider selection. They generally serve a much wider insurance market. Your direct writers or your direct agencies tend to have a very, very focused market that they're looking to. What's State Farm looking for? Hey, their motto is like a good neighbor. They're looking for middle America. They're looking for your neighbor. That's what they sell to. Your independent agency may be looking to write, inner city risks. They may be looking to write the high net worth client. They've got a much wider market that they can go after. And then there's a new situation that's come to exist in the last several years, and that is franchise agencies. These are kind of a hybrid, if you want. They're basically, if you want to get in the insurance business really quickly and you don't have companies to represent and products to sell, you go buy a franchise. And that franchisor is providing you a variety of companies to sell through your franchise agency. It's really no different than owning a McDonald's franchise or a Burger King, except you're selling insurance policies through the franchisor. It's, there's nothing wrong with the system, but personally, I don't find it very consumer friendly.
Yeah.
The franchise agencies, in my opinion, they tend to be staffed by relatively inexperienced people for the most part. Um, People just getting into the business.
Yeah.
And they are sales offices. They're almost all sales offices. Very, very seldom do you see a franchise agency where anybody's got a lot of experience and a lot of sophisticated, deep insurance knowledge. So it's not a bad system, but it is pretty limited in what it brings to the table.
Got it. And then another element of our world as insurance people that I think is lost on some business owners that would be helpful for them to understand when their broker's talking to them about the different policies that they may have. Jonathan, can you talk about the difference between retail and wholesale in the insurance world?
Sure. So retail, and when you think of retail versus wholesale, it's similar to any other business structure out there. The retail clothing industry versus wholesale. Same thing in insurance, right? You have retail, which is, they're providing quotes and in service to you directly on the street. So you can drive down the street and you see name of insurance, they're providing to you directly. Wholesale really is for specialty offices or agencies, as they call them, and they typically represent, more than 2 or 3 companies, and they're working in a specialty area. So, on the wholesale end, they are marketing to us as agents for our clients that are in the different industries. So, for example, it may be home health care, or it may be gymnastics organizations, or it may be they're only working with employee professional liability for attorneys' offices. So a wholesaler will be a specialist in one area, but provide multiple different companies for quotes because not every situation fits every company. And so when you're searching for insurance, you definitely want to make sure that you go to 2 or 3, 4 different companies to make sure that you're getting the best value, the best protection at the lowest cost.
Fair enough. That's what we like.
Yeah, and one of the things I'd like to add and just a little expand on for Lee is a lot of times we get calls when people are going to certain agencies that are offering coverage to them on the internet, and they're not working with an agent directly, they're doing it themselves. Effectively, when problems come up, they end up calling the agent back. And so when you do it yourself, you're your own agent. And so you better know the ins and outs of every business insurance contract.
Sure.
And so you can do it, but you're ultimately going to call us when there's problems.
I'm going to give you a quick sidebar to that. I'm located in Southeast Florida, and we've got lots of insurance challenges down here because of our hurricane exposures, et cetera. There was a new carrier came into the market about 1.5 years ago, and they were selling direct. They were selling primarily over the internet. And I got a solicitation, got a direct mail. I filled it out just for chuckles, sent it in, and I get a call a couple days later from just an absolutely lovely young lady who was a sales agent for them. And she was pitching me, and I played along, and we had a nice conversation. I finally said to her, I said, "Gee, you've been very helpful. I really appreciate it. I'm curious, where you're calling me long distance, where you're located?" She says, "Oh, I'm in Indiana." If I remember, she was in Terre Haute or somewhere in central Indiana. And I said, "Oh, that's interesting. Well, how did you happen to come to work for this company?" She said, "Oh, well, I just recently started. I got my non-resident Florida license, and I've been working with them for 30 days." And I said, and I'm thinking, wow, that's really fantastic. I'm in probably the toughest insurance market, the most difficult and challenged insurance market in the country. And I've got just an absolutely lovely, nice Midwestern lady speaking to me. Couldn't have been any more pleasant, who had a non-resident agent's license for 30 days and is selling insurance in Florida.
Yep.
So it might be a little bit of caveat emptor out there, folks. Buyer beware.
And we are going to run up against our time. So what I'd like to do is, and there's a bunch of points we could probably spend another 45 minutes here on online talking through, but we won't. Chris, I'm going to address this to you as the attorney on the panel here. Flop ears got their insurance policies at their renewal. What's their responsibility?
Their responsibility is to adhere to all of the technical requirements that are needed to get that renewal. But it's also to master the policy and be able to communicate with the insurer about any changes that need to be made. The company may have gotten bigger. The company may have gotten smaller. The company may have entered into a new line of business. And it's certainly on the business owner, the customer of the insurance company, to inform the insurance company what needs to be insured.
Absolutely. Buyer beware. Lee?
Buyer be alert. I was going to also make the point, if we didn't skip over my question because of lack of time, that any business owner, from the great to the small, needs to understand how to make a claim and what all the components are, and be ready to do it quickly and completely in order to maximize its chance of a favorable outcome with the insurance company. You know the details. Arrange your information, your business information, in such a way that it can be easily fed into a claim.
Lee?
Let me add to that, that virtually every policy, property or liability, has a requirement that the insurance company be notified promptly of a claim or something that may give rise to a claim. So when something happens, pick up the phone and call your agent, call your broker, talk to them, tell them the situation, tell them what transpired, and follow up with an email. That meets the policy obligation to put the insurance carrier on notice. The agent can advise you whether the claim needs to be turned in now or tomorrow or next week, or what the next step should be taken. But meet that policy obligation, because if you don't, you may find a carrier coming back and denying a claim on the basis of the fact that you didn't notify them properly.
Yes. I've a number of times where insureds withhold information on a potential claim because they're waiting to see if it might develop into one.
Yep.
And we don't want to wait. You want to communicate with your broker right away and with the insurance company, because reporting the claim isn't the same as actually getting paid out. It doesn't ding your record, right? John, anything you want to add to that?
Know the rules of the game, right? If you're playing by the rules and meet the obligations, when something happens, the insurance company typically will pay. If you're not playing by the rules, don't give the insurance company an out, and
Right.
pay
Right.
attention. Really, it's pay attention and know what is and isn't covered, and problems are going to happen. You can't stop that, but if they do happen, you want to make sure that you're covered and financially put back to close to where you were, so you can keep your operations going.
Absolutely. All right. So with that, we will conclude our webinar, and I want to thank you, Lee, Chris, John. Appreciate you guys spending time today. And I want to thank you, the listener, for joining us for another entertaining and educational production of Financial Poise. And you can look for other Financial Poise webinars wherever better continuing education webinars are sold. Thank you very much. Have a good day.
Thank you, Gary.
Thank you.
John, Chris.